And right now, economic activity is running above where it was a year ago. Not quite where it would have been absent a crisis, but almost. And so China is in very good shape. And what's especially interesting, if you look on the right-hand side, is that exports have done very well also after having catastrophically declined early in this crisis. And that's despite the fact that the global economy remains suppressed. So this suggests that despite weak global demand, Chinese exporters remain exceptionally competitive, and they have restored their economic health. The sources of growth in China are interesting in that the government has engaged in a type of fiscal stimulus relatively different from what we've seen in Europe and North America. There, state-run banks have loaned money heavily to state-owned companies. Local governments or regional governments have borrowed heavily to invest in infrastructure. And consumers have spent heavily on durable goods like automobiles, as well as on property. Where we've seen weakness in China is on consumer spending on services. And that's not surprising in that the virus is still there. People are still worried about it. And so they're avoiding social interaction to some extent. Meanwhile, there are risks to the Chinese economy. In the process of recovery, there's been a huge increase in debt. And that sets the stage for possible financial troubles down the road. Moreover, China continues to have a fraught trading relationship with the United States as well as with Western Europe, and that might mean trouble in terms of trade going forward. It's interesting that although Chinese trade has increased, it hasn't increased with the United States, rather it's increased with the rest of the world, and that reflects the impact of the troubled trading relationship between China and the United States. Let's turn to Europe, because that's where the virus went after China. And as you can see, the number of cases of the virus per capita was alarming back in April. In the major European countries, especially Spain and Italy, we saw a massive outbreak. And we saw a massive response by governments in that they imposed fairly draconian lockdowns, especially in Southern Europe, where people couldn't leave their homes for a prolonged period of time, except to engage in basic functions like grocery shopping. But the good news is that this was successful. Even though there was a catastrophic drop in economic activity in the second quarter across Europe, there was also a very sharp drop in the number of new cases. You can see in this chart that by June in Europe, the number of new cases was at a very low level, with the exception of the UK. And that was good news, and that set the stage for a fairly robust recovery over those months. The problem was that by the end of the summer, with people traveling, with people going to beaches and bars and restaurants and parties, the virus began to rear its ugly head again. And we now know that there was a sharp outbreak of the virus among farm workers in Spain who transmitted it to tourists who had come from other parts of Europe, who then took the virus with them to other parts of Europe. And by the early autumn, we had begun to see, as you see in this chart, a very sharp outbreak of the virus. Now, this in part likely reflects the fact that with cold weather or colder weather, people are spending more time indoors. And that's true both in Europe and the United States, where in both places we've seen a very sharp outbreak of the virus. And in Europe, it's already had a negative impact on economic activity and has compelled European governments to impose fairly strict economic restrictions across the continent. And that is likely to mean negative economic growth in the fourth quarter. And depending on how successful the suppression of the virus is, that will determine whether there's a robust economic recovery in 2021. Meanwhile, we can see what's happened over a longer period of time in Europe. You can see that at the start of the crisis, there was a very sharp drop in industrial production, which by the summer had not fully recovered. And you can also see on the bottom, the consumer price index, the percent change, shows that inflation essentially disappeared in Europe because of the weakness of the economy and the strength of the euro. Now, the European Central Bank has reacted strongly with a very aggressive monetary policy, but at this point now, inflation remains very low, which is a reflection of the weakness of the European economy and is a source of concern for the European Central Bank, in that lower inflation means higher real interest rates. And so the ECB has committed to continuing a very aggressive monetary policy. And you can also see in these charts the impact of the initial stage of this second outbreak of the virus in Europe. What you see before you are the Purchasing Managers' Indices, or PMIs, for services in both Germany and Spain. And the way to read this is that the PMI is above 50 if activity is growing, and is below 50 if activity is declining. And the faster the decline, the farther below 50 the line shows. So what you can see in both countries is that initially in the crisis, there was a really catastrophic decline in services activity. And services includes retailing, restaurants, bars, movie theaters, amusement parks, transportation services like airlines and trains. So all of these things ground to a halt, basically, and then bounced back very quickly once the virus was suppressed. But now, with the renewal of the virus in the autumn, you can see in Spain, which is where it began, there's once again a pretty sharp drop in activity in the services arena, whereas in Germany, which has not yet had a sharp outbreak of the virus, but is affected by what happens in the rest of Europe, you can see the line has fallen down to about zero, meaning that there is kind of a stalling of services activity in Germany. But in any event, as I indicated earlier, the current outbreak is likely to mean negative economic growth this quarter. Now, if the virus is successfully suppressed by the early part of 2021, then it's likely we'll start to see economic growth rebound. And one of the things that will have an impact will be the fiscal policy. And we've seen an extension of fiscal stimulus in many European countries, and this should have some positive impact going forward. And of course, if we get a vaccine that's really successful and widely distributed and leads to the end of the virus, then we could have an extremely robust economic recovery, hopefully by the end of next year. So let's move on and now talk about my home country, the United States. And sadly, in the US, we have not been successful at suppressing the virus as governments were in Europe and Asia. Here you can see the number of daily reported cases of COVID on a per capita basis, and it keeps going up. We've had 3 waves. Each wave is worse than the last one. The first wave in April was largely centered around the New York metropolitan area. New York imposed fairly draconian lockdowns, and that was in fact successful in suppressing the virus in the northeastern part of the US. But in other parts of the US, the virus continued. And even though many states across the US imposed economic lockdowns, they reopened too early. The federal government had provided states with guidance as to when they should reopen. And the guidance said you should only reopen after there have been at least 2 consecutive weeks of declining cases, and if you have a strong testing and tracing regime in place. Those cases were not met by any state in the US, and yet they reopened in May. That set the stage for a strong economic recovery in May and June, but it also set the stage for a rebound of the virus, because by the summer, across the United States, and especially in the Sunbelt countries, Sunbelt states, people were actively going to restaurants and bars and movie theaters, beaches, parties, retail stores, often not wearing masks. And as you can see, by the summer, we had a second very sharp outbreak in the number of cases. And fortunately, by the end of the summer, this started to abate as people started to stay home. One of the things we saw was that with that second outbreak, there was a slowdown in economic activity because people, especially older people with money to spend, became nervous about the virus and avoided social interaction, avoided spending money, and we saw a slowdown in the growth of service activity. So that in turn led to a slowdown in the virus. But that also happened at the same time that fiscal stimulus expired, and that also contributed to some slowdown in economic activity. Unfortunately, now in the past 2 months, we've seen yet again a substantial outbreak of the virus, similar to what's happened in Europe. And this has been largely attributed to cold weather, which means that people are spending more time indoors, which makes it easier to transmit the virus. And also in the cold weather, people are more or people are less immune to the flu. And when people get the flu, they're more amenable to getting the COVID virus. The interesting thing is that in the process, the death rate has been lower relative to the number of cases than was the case earlier in this crisis. And there are a number of possible explanations for this. One is that more young people are getting the virus rather than older people, and they're less likely to die. Older people have become better at avoiding social interaction, staying at home. And when people do get the virus, the medical profession has become better at treating the virus. They have better treatments, better protocols, and it may be the case that the virus has mutated in ways that make it less deadly. But in any event, from my perspective as an economist, the most important thing is what is the economic impact? And what we've learned so far is that when the virus increases, it has a negative economic impact, even if there aren't economic lockdowns. And here in the US, we haven't seen a renewal of lockdowns. What we do know from research done by the US Federal Reserve is that the lockdowns actually don't make that much of a difference in terms of economic activity. They make a bigger difference in terms of the spread of the virus. What makes the difference for the economy is fear. If people know the virus is out there, they change their behavior in ways that limit economic interaction. And the Federal Reserve did a study where they looked at, in the US, states that had severe lockdowns versus states that didn't. And they found that if you looked at the two states, that the difference in economic activity was not very great, which suggested that the lockdowns didn't make the difference. Again, what made the difference was the fear of the virus. And when the virus reared its ugly head, people changed their behavior. Now, in the US, it's helpful to look at high frequency data, which we get from credit card companies. This shows daily data on consumer spending overall. And you can, relative to the pre-crisis level, you can see early in the crisis, there was a catastrophic drop in spending, both because of lockdowns, but also because of intense fear of the virus. And then when economic restrictions were lifted and people became less nervous about the virus, there was a strong rebound. But by the summer, as I indicated earlier, we had started to see another outbreak of the virus, and this affected people's behavior. And you can see that economic activity, or consumer spending at least, began to stabilize at a level below the pre-crisis level. And this was largely due to a reduction in spending on consumer-facing services like restaurants, retail stores, airplanes, hotels, and so on. And the inference here is that until we get the virus under control, this is the new normal. We're going to see suppressed economic activity overall. Now, obviously, there are some areas of economic activity that have been strong, but the weak ones can have a negative spillover effect on the positive ones and can potentially set the stage for a more traditional recession. Now, in the US, one area of considerable strength, and an area of strength in other parts of the world as well, has been housing. Here in the US, in the midst of this crisis, because the central bank has cut interest rates and mortgage interest rates are at a historically low level, we've seen increased activity in housing. But it's not just interest rates, it's also the fact that with large numbers of people working from home, especially relatively upper income people who have money to spend, a lot of those people have made the decision that, or have made the prediction that they're likely to continue working at home for a prolonged period of time, if not forever. And if that's the case, they've chosen to buy bigger homes with bigger home offices. In fact, if you look at the market for houses that sell for more than $1 million in the US, that market is up dramatically. But overall, the sales of existing single-family homes, you can see, has increased to a level we haven't seen since before the financial crisis of 2008. So there are some positives here in the US and in other parts of the world, and which obviously have a positive impact on the DIY industry. And also in the US, as well as in Western Europe and in Asia, we've seen strong consumer spending on durable goods. And where we've seen weakness is in trade, is in business investment, and is in consumer spending on services. Now, this has been, of course, a global crisis. And as I indicated earlier, we've seen a robust recovery in China. We've seen, at least temporarily, robust recovery in parts of Europe. We've seen some strength in other parts of Asia, like Southeast Asia, Korea, Taiwan. We've seen weakness, of course, here in the US, and now weakness once again in Germany. In much of Western Europe, including Germany. But what's interesting is that if you look at these lines, which show job vacancies relative to the pre-crisis level, in every one of these countries, job vacancies remain well below the pre-crisis level, regardless of what's happened to overall economic activity. And that suggests that the global economy still remains sick. It's been estimated that globally, there are still about 500 million people who are unemployed as a consequence of this crisis. And for all of these countries that you see here, the loss of job vacancies, the loss of job postings is largely related to consumer-facing industries. Where we've lost jobs permanently, or at least semi-permanently, are in retail, in restaurants, in airlines, in aerospace companies, in hotels, in movie theaters, in amusement parks, in pubs and bars. That's where jobs have not come back. Because even though we saw some return of jobs in those industries, because of the continued existence of the virus and the fear of the virus, many consumers are avoiding those places. And many of those businesses are forced to enforce social distancing within their facilities in ways that raise costs, in ways that reduce capacity, and in ways that lead to less demand for labor. So we're looking at a global unemployment problem right now that will not be solved until we get this virus under control. And that has potentially negative consequences for many other industries, including housing. And we've also seen initially in many countries a return to visits to cafes and restaurants and entertainment venues. But then with the return of the virus, some downward movement. So if you look, for example, at Italy, which is the fourth one over on the top, you can see initially there was a catastrophic drop in mobility and visits to restaurants and bars, and then a quick rebound leading to an almost complete recovery by the summer. And now with the virus once again out of control, we're seeing a more modest but still significant decline in activity in these industries. So once again, we seem to be having waves of the virus followed by waves of declining economic activity and social interaction, which then leads the virus to abate, which then leads economic activity to move up, which once again leads to a greater spread of the virus. And I think we're likely to have these continued waves, at least in Europe and North America, until we get a vaccine. So that's a negative, but it also suggests that there's a very strong need in the interim for appropriate government policies that can at least suppress the virus to the greatest extent possible. So let's talk about government policy. I mentioned earlier that one of the main focuses of policy early on was to suppress economic activity, but at the same time, to protect people and businesses by using the tools of government. And the main tools were monetary and fiscal policy. So let's talk about both, beginning with monetary policy. And we're going to look at data from the US first. If you look on the right-hand side, this is an indicator of financial stress. And it's based on things like risk spreads, credit default swap prices, values of asset-backed securities. And you combine these together and you get an index of financial market stress. And you can see that early in the crisis, that index increased dramatically. And that was a reflection of investor fear that what we would see happen is similar to what happened during the global financial crisis in 2008. That is, there would be a seizing up of credit markets and credit wouldn't be available. So Here in the US, the Federal Reserve acted quickly. It cut interest rates, it committed to massive asset purchases. It purchased government bonds, mortgage-backed securities, corporate bonds, bank loans, municipal bonds, and you can see on the left-hand side, huge increase in the assets of the Federal Reserve System. And again, there was a similar action for the European Central Bank, for the Bank of England, for the Bank of Japan. And this was successful in that if you look again on the right-hand side, the financial stress index dropped dramatically after the Fed acted, and the Fed was successful then in keeping credit markets open and avoiding a seizing up of credit markets and enabling both households and businesses to continue to obtain credit that they clearly would need throughout this crisis. Now, an important thing to note is that when the Fed did this and when the European Central Bank did this as well, it led to a huge increase in money supply. And in normal times, big increases in money supply are inflationary. You get too many dollars or euros chasing too few goods. And think of countries like Venezuela or Zimbabwe or Germany in the 1920s during the Weimar Republic. Those were all countries and episodes that involved hyperinflation. But in this instance, we're not looking at a normal economy, and we didn't get a big increase in inflation. Instead, we got quite the opposite. And that's because with all that money being produced, it didn't get spent. It got hoarded. So if you look here, and this is for the US, on the left-hand side, you can see the blue line is the growth of commercial and industrial loans. When the Fed eased policy, businesses borrowed money with abandon, but they didn't spend the money. Business investment declined. They hoarded the money. There was a huge increase in bank deposits. They were holding that money for a rainy day. If you look on the right-hand side, private sector savings ballooned to a level we'd never seen before. Again, consumers and businesses hoarded cash, so the cash didn't get spent. So we didn't get higher inflation. We actually got lower inflation as the economy cooled off. Moreover, one could argue that once this crisis is over and people start to spend all that money and there's all that pent-up demand, we could get a burst of inflation. And that's a possibility, but it's likely that it would only be temporary because central banks have adequate tools to reverse what they've done and avoid an inflationary episode. And evidently, investors are confident of that. If you look at the so-called break-even rate, which in my mind is the best proxy of long-term inflation expectations, the 10-year break-even rate today is lower than it was a year ago. In other words, despite massive increases in money supply, investors believe that inflation over the next 10 years will be lower than they had thought a year ago. And I agree with them. I think we're not going to see a big episode of inflation. And here you can see what happened in both Europe and Asia. On the left-hand side, the blue line shows the growth of the broad money supply in the Eurozone. It increased quite dramatically early in the year. On the right-hand side, you can see the growth of money supply in three major Asian countries, especially India had a surge in the money supply. China and Japan, not quite as much, but both of them did have an acceleration in money supply growth. So this was a global phenomenon, and it was appropriate. And it will probably not have been extremely inflationary, but what it did do was keep credit markets open at a time of considerable financial market stress. And the other important part of government protection of people and businesses was fiscal policy. Here in the US, as well as in Europe, we had massive increases in government spending. And it involved continued support for households. Here in the US, you can see on the left-hand side, there was a huge surge in the growth of personal income because of the enhanced unemployment insurance that we had. But on the right-hand side, you can see that there was also a historic drop in consumer spending. So even though people suddenly had a lot more money, they didn't spend it. They put it aside. They saved a great deal. And so what we have called fiscal stimulus wasn't really stimulus. It was more protection. It prevented households and businesses from failing on a large scale. We did see some failure of households and businesses, and we probably will see more. But in the absence of this type of fiscal policy, it would have been much worse. And just comparing the US and Europe, in the US, we had massive transfers of money to households. We had $1,200 stimulus checks to every household. We had forbearance on mortgages. We had extra unemployment insurance. We had loans to small businesses that could be forgiven. In Europe, there were the so-called furlough schemes. Rather than direct money to people, there were subsidies to businesses that kept people on the payroll. The effect was the same. It avoided people losing large amounts of money. And of course, in Europe, there was also the aggressive monetary policy of the European Central Bank, which committed to massive purchases of member state bonds, which enabled those member states to engage in their own expansive fiscal policies at a relatively low cost. And then we saw the European Union borrow 750 billion euros, a novel thing by European standards, and provide that money to member states. In both Europe and the US, we saw a massive increase in government debt. What's different, though, is that in the US, all that fiscal stimulus expired at the end of July. And even though here in the US, there was bipartisan support for further extension of fiscal policy, the White House and the Congress could not agree on the details, and so far have not. And so we haven't had stimulus since July. And in fact, in August, after the stimulus expired, personal income dropped sharply. Interestingly, consumer spending did not. It only decelerated. Evidently, American consumers didn't get the memo. They continued to spend money. They dipped into their savings. They saved less. They borrowed more. And that continued into September, when we saw relatively strong retail sales. It's not clear how long this can go on, but what we do know now that Joe Biden has been elected US president, and he supports further fiscal stimulus, although he's likely to face a Republican Senate, I think it's likely there will be some kind of stimulus passed after he takes office on January 20th. So that's sort of the state of the world, and we're looking at the likelihood of weak or negative economic growth in the fourth quarter in Europe and North America because of the rebound of the virus, continued strong growth in Asia, and then in 2021, my expectation is that growth will be modest in Europe and North America, and then only take off after a vaccine is clearly in place. So the hope now is that this vaccine will be successful, will be produced widely and distributed widely and used widely. And then by the end of next year, we can be confident that the virus is largely behind us. And at that point, consumers, especially those who have become immunized, will feel more comfortable going out and acting as they did before the crisis, spending money, and we could actually have a very robust global economic recovery. But the question is, what does a post-COVID world look like? And will there be permanent changes in the way people and businesses behave that will affect your industry and other industries? Well, first, let's talk about what I've been doing for the past 8 months, which is working from home. Based on the conversations I've had with the leaders of my firm and leaders of many of our clients, it's likely that going forward, a large number of people will continue to work from home. Many business leaders have told me, anecdotally, that they intend that a significant share of their workers will spend a significant share of their time not in the office, but working remotely. And if that's the case, that means less traffic on the road, less use of public transportation, less energy demand, and lower energy prices than would otherwise be the case, fewer office buildings or less demand for office space, with potential trouble for financial markets that have backed commercial mortgages. And it could have an impact on worker productivity. Working from home using technology has benefits. It does increase my own productivity and probably the productivity of millions of others. And so if we get productivity gains, we could get faster economic growth and higher living standards in the future. On the other hand, if we never interact with each other personally and have those informal conversations and sharing of information, that could stifle innovation and stifle productivity growth. So the goal, hopefully, will be to find the right mix between remote interaction and in-person interaction. And then there's online shopping, which was already growing rapidly before this crisis, has grown even faster during the crisis, and there's probably no going back. I suspect we'll have fewer retail stores, fewer or repurposed shopping centers, and more online retail interaction. We'll probably have more virtual meetings, although I think eventually we'll get back to meeting in person, but maybe not as much. And that will have a negative impact on the airline and hotel industries and require more restructuring and rethinking of those industries. And then very importantly, there's the issue of supply chains. Early in this crisis, many global companies recognized that their global supply chains were really Chinese supply chains, because when China shut down, had a huge negative impact and a disruptive impact on global supply chains in multiple industries. And then of course we saw disruption in Europe and North America as well. So I think a lot of companies that traditionally looked at their supply chains in terms of just-in-time inventory management, the fastest movement of goods, the cheapest, most inexpensive goods available to their customers. And while those things will remain important, increasingly I think companies will think about redundancy of supply chains, resilience of supply chains, diversification of supply chains. And that might mean moving resources out of China and putting more resources into, say, Vietnam or Mexico or Turkey or elsewhere. Or maybe bringing some parts of supply chains back to the home market in the US or Western Europe or Japan. It's interesting that the Japanese government is providing subsidies to Japanese companies so that they either move supply chains out of China into Japan or into Southeast Asia based on cost considerations. I think we'll see more of that. And that raises a question about China's role in the world, and especially the US-China relationship, which has been very fraught in recent years. And you may recall that a year ago, before we knew anything about a pandemic, there was a trade war between the US and China, where both sides had, beginning with the US, had put up substantial tariffs. That had led to a drop in the growth of trade, a drop in the growth of investment, a slowdown in the global economy, and a significant fear that 2020 would see a recession as a result of the trade wars. Of course, 2020 did get a recession, but not because of that. In fact, by early 2020, in January, there was a so-called phase one trade agreement between the US and China, where the US avoided new tariffs and China committed to massive increases in purchases of US goods. Of course, COVID threw that out the window, and the relationship once again became very fraught, especially as the US sought to restrict technology transfers in both directions between the US and China became more aggressive with Hong Kong, with India, with Taiwan in the South China Sea, and the US imposed sanctions in return. So the relationship became very fraught. And yet at the same time, China sought more inbound investment from foreign companies. Many global companies, including US companies, continued to be interested in operating in China, both from a supply chain perspective as well as targeting the vast Chinese market, especially at a time when China's economic growth appears to be shifting more toward a focus on domestic demand rather than export demand. So it's not clear what the relationship will be going forward, but what is clear is that it will be very much affected by the outcome of the recent US presidential election. We now know that Joe Biden will be the next US president, even though President Trump has not yet accepted the outcome of that. The outcome is actually quite clear. And so what does this mean? Well, you'd be hard-pressed to find two more different visions of the US role in the world and the nature of the global economy than the visions offered by these two men. For much of the post-war era, there was a bipartisan consensus in the US for globalization. The US actually created many of the international organizations and agreements that underlied the global economy. The US pushed for freer trade, freer movement of capital, freer movement of people. Under President Trump, there's been a partial reversal of that. Trump has withdrawn the US from some organizations and agreements, imposed fairly severe tariffs, the highest since the 1930s, imposed restrictions on cross-border capital flows, and imposed restrictions on immigration. Now that Biden has been elected, my view is that he's likely to, at least in part, reverse some of that. He will clearly renew U.S. membership in various organizations and agreements. He has pledged to have the U.S. rejoin the Paris Accords, the Iran nuclear deal, the World Health Organization, to help rebuild the World Trade Organization, to remain committed to NATO and the European Union, to avoid tariff wars with the European Union. And even on China, Biden has said that he will reconsider the tariffs that Trump has imposed, although on the other hand, he said he wants to use U.S. tax law to discourage U.S. companies from investing in China. And he's also likely to reverse much of the immigration policy of the Trump administration. And there are many other policies that will change. However, it's likely at this point that Biden will face a Republican Senate, which will make it difficult for him to pass a lot of the domestic legislation that he would like. So I think, at least for the first 2 years, he's likely to be very much an international president that is focused on foreign policy, trade policy, international economic policy. And I think that will mean less of a focus on deglobalization than we've seen lately, and more of a focus on rebuilding, at least partially, the global economy. On the other hand, Biden will face resistance from within his own party. Within the Democratic Party, there is a strong protectionist impulse. So he will have a difficult path to navigate, but my expectation is that he will move the U.S. back in a globalist direction. Then another big issue that the global economy faces is climate change. And this will persist long after COVID. And what's been interesting about COVID is that because of a sharp drop in economic activity, we've actually seen a drop in carbon emissions. But it's not just because of a drop in global demand, it's because of a change in behavior, more remote interaction, more working from home, more shopping from home, more being entertained from home, less travel. All of those things, many of which are likely to persist after the virus is gone, have led and will lead to a decline in carbon emissions. So that's a good thing, but it's still a very big issue and will be a big issue. And many governments will continue to attempt to reduce carbon emissions substantially, with the European Union and Japan committed to reaching carbon neutrality by 2050, China by 2060, and now under Joe Biden, the US likely will have a 2050 deadline. But even absent government action, what's interesting is that the private sector is already beginning to address this issue on its own. Financial institutions are increasingly pricing assets, pricing risk, and making portfolio allocation decisions in part on the basis of climate risk. And if that's the case, other industries are going to have to respond to that as well. So I think we will see going forward a very substantial focus on this issue, which will have a big impact on the global economy. We've already seen an impact on geopolitics. If you look at the recent agreement between Israel and the United Arab Emirates to develop diplomatic relations, I believe it partly had to do with climate change, because the UAE probably recognizes that the writing is on the wall. All oil and gas are going to decline in importance in the global economy, and the UAE needs to diversify away from carbon-based fuels and more toward perhaps technology. And what better way to do that than to develop an alliance with the Middle East technology powerhouse, which is Israel. Russia, on the other hand, has not moved in a substantial way to diversify its economy away from a dependence on carbon-based fuels, and so its future is more problematic. Let me finish by saying that I talked about how there's likely to be some productivity gains as a consequence of COVID, and yet in the process of moving toward a bigger economy with better living standards, there will be substantial disruption of labor markets. There already has been, even over the past 30 years with implementation of information technology, we've seen a big reduction in the demand for low-skilled workers, an increase in the demand for high-skilled workers, and yet there hasn't been a commensurate shift in the composition of the labor force in many countries. And that's led to rising income inequality in some places, and it's led to reduced job market opportunities for lesser skilled workers. And in this pandemic, that's been especially true because of the shock to industries that employ large numbers of low-skilled, low-wage workers, like restaurants and retail and hotels and movie theaters and so on. And if we don't see a reversal of that, and we may not, we will see the permanent loss of many low-skilled jobs and an exacerbation of income inequality. So as we move toward faster economic growth potentially as a result of this crisis, we might move toward more crisis in terms of the global labor market. And that will require more government investment in human capital so that eventually we can have a labor force that meets the needs of a changing business environment. So those are my thoughts about the global economy. And John and Sergio, I'm happy to take questions.
Okay, well, yeah, thank you very much, Ira, for this always very informative speech. And as I said earlier, one is always a lot clearer about the situation after you've spoken than we were before. But what about the debt? How are we going to pay that off? Are we going to pay more tax in the future? And we've been borrowing tons of money. First of all, I don't know where it came from. And secondly, how are we going to pay it back?
Well, the thing is, the reason you would normally worry about governments borrowing too much is that when they borrow in competition with the private sector, and there are scarce funds available, that would lead to a rise in bond yields and would stifle business investment. That has not been the case. Bond yields have not risen. They've actually fallen in most countries. And now that's partly because central banks have bought a lot of those bonds. And normally when central banks do that and have a huge increase in money supply, that leads to inflation and expectations of inflation. And that hasn't been the case either, which is another reason bond yields have remained very low. So evidently the markets are telling us they're not worried about the level of borrowing. Moreover, the institutions that normally worry about these things, like the IMF and the OECD and central banks and investment banks, have all been saying, don't worry about it. Borrow like there's no tomorrow because we need fiscal stimulus. So my view is, I'm not worried about it. I would look at it as being similar to what happened in World War II, when countries like the US and the UK borrowed heavily to fight an enemy and defeat the enemy. And once the enemy was defeated, then government spending could go back to normal levels. Economies grew with a little bit of inflation. The debt to GDP ratio fell, and it became less onerous. I don't think we'll need higher taxes or a substantial reduction in spending. I think what we need is policies that make the economy grow. And in the short term, we need policies that get the virus under control.
I shall tell my wife when I go home tonight, because she keeps telling me we're going to pay a lot more money in the future. But I'll tell her that you said we won't. Okay. The other thing is, we've only heard about the vaccine for the last 24 hours. But then I've seen the share price of home improvement stocks around the world. They've gone on a nosedive. They've gone very low, sometimes more than 10, 15%. Why is that? And what do you think about that?
Well, I think what we've seen is investors have responded to the news about the vaccine by becoming favorably disposed toward the kinds of companies that were severely disrupted by the virus, like retailers, restaurants, airlines, aerospace companies, hotels, and so on, and becoming less interested in the companies that benefited from the virus, like food delivery services or online streaming of entertainment. And housing would be one of them. I mean, one of the things we've seen, because people have been working from home so much, we've seen people buying homes and buying things for their homes. And so home improvement companies have done very well. So there's now an expectation that with a vaccine, people will go back to normal types of behavior, get on airplanes, go to hotels, and not spend on home improvement. I think they've got it wrong. I think that even after this virus is over, we'll continue to see more remote interaction. And I think we will see more demand for larger homes and more demand for things related to the home. So I think that home improvement companies will actually do well in the future, and perhaps the markets got it wrong in this instance.
Okay, well, thank you very much. I've got a few questions here. Wait a minute. Yeah, here we are. We have a clear, from Harold, with a clear increase in unemployment as well as the introduction of AI workforce. Do you see the discussion surrounding a universal basic income becoming more prominent?
Yes, I think we will see more debate about that. I'm not sure even where I stand on that issue, but clearly, I mean, with technology disruption, which was already underway before the pandemic, and then the pandemic itself having probably a permanent disruptive impact on some industries that employ large numbers of low-skilled workers, there's going to be a need to think about what to do about people who are permanently disrupted. And, obviously the ideal thing is to retrain people, but it's not realistic to expect that we're going to retrain everybody, especially people who are later in their careers. It's more difficult to do that. So there might be a need to think about a basic income, especially if these technologies lead to faster economic growth, increase the size of the pie, then we can share part of that pie with the people who have been most disrupted by those new technologies.
Okay. Now we have a question from Jim. Sources and studies throughout Europe have found an increased desire for people to move out of the cities. What impacts do you foresee this relocation and urban to rural migration having on the economics of cities as well as the housing market?
That's a very good question, and there's a raging debate about this right now. And we've seen in both Europe and especially here in the US, a sudden move out of cities. I mean, here in the US, I'm old enough to remember when cities were very troubled back in the 1970s and 80s. And then suddenly there was a renaissance of cities in the 90s and the early part of this century. And we saw my own hometown of Los Angeles, as well as the city where I grew up, New York, both see their downtowns revive in a terrific way. And now this year, that is starting to be reversed, with people leaving cities and going to suburbs and rural areas and interacting remotely and making cities look almost like ghost towns. And it's very scary. And so there is a debate, and the debate says, well, on the one hand, the technology enables us to have a thriving economy without big cities. The other side of the argument is that throughout human history, cities have been where people have clustered. Regardless of technology, they've done it because they need to informally share ideas with each other, and businesses need to have a pool of labor available of people who can get together and innovate together. And without cities, we don't get that kind of innovation. My own feeling is that as human beings, we need to be near each other. We need to have that interaction. We thrive on that. So I think cities will survive, but maybe in a different way. And maybe there will be a transition that will be very disruptive and maybe very costly. But I think at the end of the day, we will remain an urban-based society.
Okay, well, thank you very much. Now we have another question from Ralph. He represents the German manufacturing base here, the manufacturers. He said, you highlighted that in a post-COVID world, US companies will aim to diversify their supply chains with a particular look to Latin America. Could these companies also look increasingly towards Europe, do you think?
American companies?
Yes.
I think just in terms of proximity, probably Latin America makes more sense. But it depends on what the skill sets are and what things can be found in different places. So obviously American companies were very much attracted to China and Southeast Asia because of the cost and the skill level and the infrastructure. they're attracted to Latin America because of the free trade with Mexico, because of the close proximity, and because of the skills and the capabilities. If there are skills and capabilities in Europe, especially Central and Eastern Europe, that would be useful for American companies, I don't see anything to stop them from investing. And certainly in Western Europe, there is a tremendously productive manufacturing base in certain industries that the US still relies on. The US relies on luxury goods from Italy and France, relies on capital goods from Germany, relies even on automobiles from the UK. I actually drive a Range Rover, which was manufactured in the UK. So,
sure?
so
Yeah. Okay. So now I've got another one here. Do you see an increase in economic ecosystems, for example, large companies collaborating to a greater extent?
I guess the question isn't completely clear. I mean, I think companies already do that to a large extent in many industries. There are ecosystems, and there is, I think there are greater networks of businesses than there used to be. I mean, we have a sort of web-based global economy where any product you buy was actually made in maybe 100 different countries because of these global value chains and that involve lots of cooperation across boundaries. Now, during this year, and certainly during the trade wars that were launched by the US government, we've seen some disruption of that. But I think the business community will still support having those relationships. And I think increasingly governments will recognize the advantage of allowing those relationships to flourish, but maybe at the same time using the resources of government to protect those people that are disrupted by those relationships.
Okay, now I've got a question from Thierry. I think it's Thierry Coman. It could be a question from me, or it could be the group CEO of Kingfisher. What impacts of the US election do you see in regard to Brexit and the US and EU relationship? I know you, but Boris Johnson has previously been described as a physical and emotional clone of Donald Trump by Joe Biden. Can a favorable relationship develop between them, do you think?
I think so. I mean, Biden is a person who has literally decades of experience in foreign policy, not just as vice president, but before that as chairman of the Senate Foreign Relations Committee. And he has often said that the basis of foreign relations is relationships. And he knows many of the people who are leaders of countries around the world. And I think he will recognize that it will be in the US interest to develop a closer relationship with Boris Johnson. That being said, Biden was not a supporter of Brexit, and certainly not a supporter of the UK disrupting the relationship with Ireland. Biden himself is Irish American and has close ties to Ireland. And I think if, as Biden has said, as Nancy Pelosi, the House Speaker in the US, has said, if the UK goes through with the disruption of the trading relationship with Ireland, it will be very unlikely that there will be support in the US for a free trade agreement between the US and the UK. So that's going to be a very particular issue.
Mm-hmm. Okay, well, I think those were the questions. I've got one question here, but probably it's a little bit out. Online marketplaces have changed the way the consumer and boost consumer spending. There's been a boom on online sales. However, there are also cause for concern due to the significant rate of non-compliance and dangerous products at the expense of customer safety buying online. The absence of a clear liability regime also makes channel retailers at a competitive disadvantage. What are your views on the future regulations of these marketplaces? Is that one for you? Or?
I mean, I have to confess, this is not my area of expertise, but I think that obviously it's an issue. I mean, as the online world has developed, often in a almost Wild West kind of way, ultimately governments around the world will want to more carefully scrutinize what happens in order to protect consumers from unscrupulous businesses. So I would expect there'll probably be more regulation going forward, but again, I don't know enough about the details of that.
Okay, all right. Well, thank you very much. I know that